Hi everyone, Stats Trader is here, and in this video I'm gonna show you a few trades that I've made just the past few days. I think I made over $800, so nothing crazy. I'll also give you 3 money management tips that actually work. Alright guys, so I just logged in into my trading account. And as you can see, today I've made a little over $500, so it's $504.32 to be exact. And it was this stock called AXTI. So let's just go ahead and review it. So I'm gonna go to trades. So my entry was around 675.93. That was the average. So 700 shares at this price. And let's just go ahead and see what happened. So it was a massive drop. The stock opened at, let me see here, $9. And in the first hour and a half, it dropped all the way down to $6.53. And again, it's not the rocket science. All you do, you just wait for this push, and I bought 700 shares here. Now, normally I risk around $500 per trade, but in this case, my risk was less than 20 cents. So 20 cents times 700 shares, it's around 140 bucks. So I only bought 500 shares here because I knew that if stock drops even further, which in my previous video I was talking about a lot, stock usually does that. I would have bought another 500 shares and then another 500 shares. The bottom line is I can't risk more than $500 on a trade, but in this trade and for this particular strategy, you know, you risk $140, $150, and you make 500, and this is exactly what happened. So that's where I bought around 675, so right here, and I think I exited. Let me see. So I sold at 748 and 748, so it was right here. So 748, it's actually the 20% or 17%. So that's the tip number one. You need to space out your positions accordingly. And I'm gonna draw a few things to show you how to spread out your positions so that you spread out the risk evenly, and even if stock goes against you, once it turns around, you can still make some profit. Okay, and today's Tuesday, September 14th, and I made another $301 just did buying this stock. So let's go ahead and see my trades. So it was this ticker ATER, and my average was around 11.24, and I sold at 11.85, and it was 500 shares. So tip number one, always break down your positions in several parts. Now what that means is whenever you want to buy a dip or you want to short a parabolic, don't short or buy the whole size all at once. Why is that? Well, from my trading experience, I can conclude that it's very hard to catch the very bottom of a stock or the very top. And most of the time you're not gonna do it. It's just the way the market is. It's very hard to predict the top or bottom. So, you know, short 1/3 of the size, and if you're wrong, another third, and buy another third, right? That way you can improve your average entry, and thus you can improve your profits. So tip number one, we need to break down our position size, because remember, if we're doing the dip buy strategy, remember we had this average drop was 34%, and then one standard deviation was 44%. So there's a huge chance that a stock is going to drop lower than the 30%. That's why, let's say you have a stock, right, and it was $10, and then it drops, or you have your let's say 30% drop was here, so it dropped to 7. So right here, well, there's still a big chance that the stock will keep going down. And let's say right after that there was two green candles, right? So you had this strong push and another green candle here. And so let's say you bought it here somewhere, right? You buy it at the bounce. Well, there's a still big chance that the stock will keep going down, because a lot of our data is actually right here to the right from our mean. So there's a chance that stock will keep dropping, right? So what I'm suggesting doing is go 1/3 of your total size here, and then when the stock keeps dropping, buy another third. And that's how, when it actually bounces, your average is going to be around here. So if you buy 1/3 here, 1/3 here, your average is going to be here. And then when the stock decides to bounce finally, you make your 20%. So that's the tip number one. Break down your positions into several sizes. So tip number two is cover all of your position at once. As I said in the previous tip, you have to break down your entries because it's very hard to predict the top or bottom of a stock. But by exiting your positions all at once, you'll make sure that you're sticking to your statistical averages. For example, your profit target is $500 on a trade, and then your risk is also $500 on a trade. You're dip buying a stock, and then the stock bounces, and then suddenly you decide to cover half of your shares, right? You decide to sell half of your share size and leave another half. Well, let's say your profit target was 20% bounce or 30% or 80% bounce, whatever your statistics are, and you cover half the size half the way. So instead of making $500, you're making like $300. So you see what I mean? On a losing trade, you're losing $500, and on a winning trade, you're making only $300. So this money management is not efficient, and it's very hard to grow your accounts if your money management is not on point. Yeah, so tip number two. So the same scenario, let's say we have a stock that was $10, it drops to $7, and then you see this bounce and you buy it at $7.20. And let's suppose for this strategy, for a dip buy, we were gonna go in 1,000 shares, but we're smart about it now, and we're buying 500 shares first, because if it drops, we're gonna buy another 500 shares. So buy 500, 720, 500 shares. Let's suppose the stock drops to 630. You have this bounce, but another 500 shares at 650. So we're gonna write 500 shares at 650. This will bring our average to 6.85, and that's 1,000 shares. And then let's suppose we're doing some kind of a trading, so we don't really close our position all at once, and let's suppose that our price target is $8. So at $8 we should sell all of our shares. So $8, it's our take profit. But then let's say a stock went up to 730 and we sold 500 shares here. So we sold 500 at 730. Now again, our average was 6.85, and we just made ourselves a profit of $225, right? So profit $225. We calculate the second part of our target, so we get $1.25 times 500, and on the second we made $575. So 1.25 times 500, that's gonna equal 575. And now we add these two, our total profit is $800. So total profit is 800. Very good, right? Well, there's a better way. So let's say if we didn't do this trade, if we didn't sell at 730, what we could have done differently, we got our average to 6.85 and we hold it till 8, all 1000 shares. So let's calculate what would we have in this case. So 1000 shares, and that leaves us with $1,150 profit. So you see the difference? Now by trading it, by closing all of our positions all at once, we're making $350 more than if we just do some kind of trading within our trading, if that makes sense. That's why I'm a strong advocate to never covering partial shares. I always stand for just covering all together. So of course you can break them down on the way down, but I usually never close partial shares on the way up when I'm in profit. That's how I maximize profit. Tip number 3 that works is always wait for the move that confirms your entry. So for example, if you're a dip buying a stock, right, you don't just wait for, according to our data from the past videos, you don't just wait for the 30% and then you buy a stock. No, it doesn't work like that. You always need to wait for this counter spike. So let's say a stock dropped from 10 to 5, so 50% drop, and then you're waiting for this strong green candle or a few green candles. That way you have this counter move. So after this counter move you can enter. So this counter move actually tells you that, okay, this is the time for me to enter the stock. And then you can set your stop loss. Tip number 3 in your risk management is, let's say you want to dip buy a stock, always wait for a move that counters the main move but confirms your entry. So what does that mean exactly? So the same scenario, stock drops from 10 to 7. Now let's say stock just drops 30% and you decide to buy it right here. It's much better, and statistically you have much better odds if you wait for the spike first. Okay, so if you wait for the spike first and you buy it here, and you can set your stop loss here, you have much higher odds of winning than, let's say, if stock drops from 10 to 7 and there's no any kind of spike and you bought it here. Well, the chances are the stock gonna go much lower and then it will have a spike, you see. So this is exactly how, and this trick actually I use it all the time, literally in all of my entries. I never try to guess where my top or bottom is. I just let the market to show me where my top or bottom, just by this simple thing. Alright guys, thank you for watching. If you have any questions, leave them in the comments below, and see you guys next time.